$40 million. Gone in 18 months. No fraud, no crash, no obvious mistake. It is March 14th. The estate attorney's office is on the 22nd floor. The patriarch died 9 weeks ago. Catherine Larsen is the first to arrive. She sits across from a woman named Margaret Chen and asks the question that will end her family. She does not know that yet. None of them do. This is not a story about bad investments. The investments will be fine. The trusts will be fine. The lawyers will do their jobs. The Larsen family will still lose the money. You are about to watch the collapse of a $40 million estate in 5 movements. You will see why most of what makes generational wealth disappear is not financial. It is structural. It is relational. It is calendrical. The architecture that protects the assets cannot protect the family from itself. There is a study you have probably never read. The Williams Group followed 3,250 wealthy families over 20 years. 70% of them lost the fortune by the second generation, 90% by the third. Williams and Prizer, Preparing Heirs, 2003. The collapse is not the exception, it is the base rate. You are watching the most common ending in private wealth, told slowly enough that you can finally see how it happens. Robert Larsen built a regional industrial supply business over 31 years. He sold it in 2019 for $58 million before tax. After the sale, his net worth sat at roughly $42 million across 3 buckets: a concentrated equity position in the acquirer's stock, a mid-Atlantic real estate portfolio, and a brokerage account managed by the same advisor he had used since 1994. He died on January 8th. Heart attack. He was 67. His will divided the estate 3 ways among his children: equal shares, clean language. Margaret Chen, his estate attorney for 22 years, had drafted the document herself. The will was airtight. The will was the easy part. What the will did not say, what no will ever says, was who would operate the wealth, who would decide, who would sit across from Margaret Chen on March 14th and ask the question. The will assumed the children would figure it out. The will was wrong about that. The will is always wrong about that. On paper, Catherine Larsen inherited $13.3 million. In practice, she inherited a problem her father spent 31 years not solving. I have watched 11 families sit at that table. Margaret Chen has watched more. The first signal is always the same. The eldest child arrives alone. The spouse is parked in the lobby, or at home, or already gone. The eldest arrives alone because she is still pretending this is going to be simple. $18 million of the estate sat in a single stock, the acquirer's stock. Robert had received it as part of the sale and had held it for personal reasons that no longer applied. He told his advisor he would diversify. He never did. This is not unusual. This is the rule. There is a paper by a finance professor named Hendrik Bessembinder. He looked at every US stock from 1926 through 2016. He found that 40% of them had a lifetime return worse than a 1-month treasury bill. Just 4% of stocks created the entire net wealth of the US market. The math is simple. If you inherit one stock, you are statistically holding a losing ticket. Unless you are holding one of the 4%. The Larsens were not holding one of the 4%. The acquirer reported a weak quarter on April 22nd. The stock fell 19%. 3 weeks later, it fell another 11. By June, the $18 million position was worth 12.4. Catherine called the advisor. The advisor told her to hold. He had told her father to hold. He told her brother to hold. He told her sister to hold. He had told everyone to hold for 30 years, and it had worked for 30 years, and that was the only thing he knew how to say. Daniel Larsen sold his share at the bottom. Catherine held. Vivian Larsen Park sold half. By the end of June, the three siblings owned 3 different versions of the same stock at 3 different cost bases, and none of them were speaking to each other about it. The first $5.6 million of the inheritance was gone. Nobody had spent it. Nobody had stolen it. It had simply ceased to exist. On paper, the estate had lost a position. In practice, the estate had lost its centre of gravity. The Williams Group study found something most people who read it want to ignore. Of the families that lost generational wealth, 60% of the failures were caused by a breakdown in trust and communication, 25% by unprepared heirs, only 15% by legal, tax, or investment errors. Williams and Prizer, Preparing Heirs, 2003. The lawyers do their job. The accountants do their job. The dinner table fails. Catherine wanted to keep the real estate intact. The portfolio her father had built, 6 commercial properties in Maryland and Virginia, generating roughly $900,000 of net cash flow a year, was the part of the estate she actually understood. She had walked those buildings with him as a child. She wanted to run them. Daniel wanted to sell. He had 2 children entering college. He had a wife who had wanted out of the marriage for 3 years and was now using the inheritance as the leverage to leave it. He needed liquidity. He needed it now. Vivian wanted neither. Vivian wanted a check. There is a moment in every family wealth transition where the siblings stop being siblings and start being shareholders. The Larsens reached that moment in late August. The conversation happened by email. The email was forwarded to lawyers within 48 hours. By October, 3 different attorneys were sending 3 different letters to Margaret Chen. The legal fees that month were $71,000. The legal fees of the next 12 months would be over $400,000. Money that does not appear in any market drawdown chart. Money that simply leaves the estate the way water leaves a cracked vessel, quietly, continuously, and only noticeably once it is gone. Catherine and Daniel have not spoken since Thanksgiving. They are not estranged for a reason you would put in a movie. $13 million is the wrong amount of money. It is enough to ruin a relationship. $20,000 would have left it intact. This is not a mistake. This is a design. I had a mentor named Henrik Voss. He ran a small family office in Connecticut for 2 decades. He told me something I did not understand for years. He said, "A $40 million fortune is the worst size to be." I asked him why. He said, "Because you are rich enough to need the architecture, and poor enough that the architecture will eat you." A single family office, a dedicated team to manage one family's wealth, has a fixed cost floor. Estimates vary, but the consensus across Camden Wealth, EY, and Deloitte Family Office benchmarking is that a small SFO runs roughly $1 to $3 million annually in operating costs. Fact check. Camden Wealth Global Family Office Report. EY Family Office Guide 2022. To absorb that cost without dragging on returns, you need somewhere between $200 and $500 million in assets. Below that threshold, the math inverts. The infrastructure that protects the wealth becomes the thing consuming it. The Larsens did not build a family office. The Larsens did something more common and more expensive in the long run. Each sibling hired their own advisor. Catherine kept her father's man, the hold-everything advisor, charging 85 basis points on a shrinking portfolio. Daniel went to a private bank that placed him in a managed program at 1.25%, with internal mutual fund fees of another 50 basis points layered underneath. Vivian, who had remarried a man who had opinions, ended up with a wealth manager in Boston who charged 1.5% and rotated her into a private credit fund with a 2-year lockup. By the end of year 1, the 3 siblings were collectively paying roughly $400,000 a year in fees. The portfolio no longer functioned as a single portfolio. They were paying for fragmentation. They were paying 3 times for what their father had paid for once. The structures were no longer coordinated for tax. The tax efficiency Robert had built over 2 decades was gone. It took 12 months. On paper, each sibling had a competent advisor. In practice, the family had no architecture. Here is the part nobody tells you about generational wealth. There is a clock running on it that has nothing to do with markets. The federal estate and gift tax exemption, the amount you can pass to heirs without triggering a 40% transfer tax, is currently set at $13.99 million per individual. It was nearly doubled in 2017 by the Tax Cuts and Jobs Act. That doubling is scheduled to sunset on January 1, 2026. Absent congressional action, the exemption will be cut roughly in half. Fact check. IRS Code Section 2010, Section 2631. TCJA Section 11061. IRS Revenue Procedure 2024-40. Robert Larsen knew about the sunset. His attorney knew. The plan, sketched on a yellow pad in 2022, had been to fund a dynasty trust with a significant portion of the estate before the deadline, to lock in the higher exemption and shield the next generation from the generation-skipping transfer tax. Robert died before the trust was funded. His children are 18 months into their inheritance. They are not speaking to each other clearly enough to execute the plan. The plan would save the next generation roughly $14 million in transfer taxes. The deadline is not negotiable. The clock does not care about the litigation. The architecture does not care who occupies it. It only requires that someone does. By month 18, the estate that began at $42 million holds approximately $28 million in net assets across the 3 branches of the family. Roughly $5 million was lost to the concentrated stock, $2.5 million to legal fees, taxes paid early, and forced sales. Another $4.5 million sits trapped in the wrong structures. Some of it is illiquid, some of it is mistitled. Some of it will trigger taxable events if disturbed before specific dates. The siblings cannot agree on the dates. The estate did not collapse. The estate is functioning normally. This is exactly what the architecture does when nobody is operating it. Here is what you should take from this. The Larsen family did not lose their fortune to a market crash. They did not lose it to fraud. They did not lose it to a charismatic advisor who walked off with a wire transfer. The collapse you just watched was the most ordinary collapse there is, and that is precisely why it is the one almost every family executes. Generational wealth is not an asset, it is an operation. Assets are static. Operations require someone, every day, making decisions in coordination with other people who are also making decisions, inside a structure designed to outlast the people who built it. The estate plan was perfect. The will was airtight. The advisor was competent. The lawyers were professional. The accountants filed everything on time, and the family lost roughly 35% of the estate in 18 months. None of those professionals could do the one thing that mattered. They could not sit Catherine and Daniel and Vivian in the same room. They could not make them speak to each other. The clock ran out before the conversation started. You will not remember the numbers. You will remember the moment you understood the pattern. The pattern is this. Wealth dies in the gap between the document and the dinner table. The document holds, the dinner table fails. Everything else is arithmetic. I have watched this happen in 2009. I watched it happen in 2020. It is happening now, in living rooms in Greenwich and Houston and Atherton, with portfolios of 40 million and 200 million and 4 billion. The size of the fortune does not change the mechanism, only the size of the loss. The ledger always balances. Eventually. Somewhere tonight, another woman opens another estate file. She is 41 years old. She is the eldest of 3. Her father was buried 6 weeks ago, and her mother is on month 2 of a grief that has not yet learned what is coming. She thinks this is about the will. She thinks the hard part was the funeral. She thinks the lawyers will handle it from here. She will learn it was about the 18 months after the will. She will learn that the document was the easy part. She will learn that her father gave her everything he could put on paper, and nothing he could not. The architecture doesn't care who occupies it. It only requires that someone does.